You've probably heard about momentum investing, right? It's pretty much taken the Indian market by storm, promising these incredible returns. But what if the whole story we've been told is, well, a myth? We're about to dive into some groundbreaking research from BacktestIndia.com that completely flips the script on where momentum returns actually come from.
Okay, let's start with the number that gets everyone excited. 14.60%. That's the compounded annual growth rate, the headline figure, for the Nifty 200 Momentum 30 index strategy over the last 19 years. And look, it's an amazing number, right? It's the whole reason thousands of cores have flooded into momentum funds. It looks like an absolute no-brainer.
But is that the whole story? Is that 14.60% really what it seems? Or is it just an average that's hiding a much more important and, frankly, shocking truth? To figure this out, we need to look at one simple but really powerful metric.
And that metric is called scaled turnover. Now, it might sound a little technical, but it's super simple. You just take a stock's daily trading volume and divide it by its total market value. All it really tells you is how liquid a stock is. A high number means it's traded a ton, very liquid, easy to get in and out of. A low number, that means it's illiquid or lightly traded. Believe it or not, this one idea is the key to unlocking this entire puzzle.
All right, now this is where things get wild. The researchers over at BacktestIndia.com did something brilliant. They took that whole universe of momentum stocks and split it right in two. On one side, you have the illiquid, low-turnover stocks, and on the other, the liquid, high-turnover stocks. And as you're about to see, the difference in how they performed over 19 years is just staggering.
And wow, just look at this chart. It lays the whole thing bare. The illiquid momentum stocks, they delivered an incredible 19.43% per year. I mean, amazing. But then look at the liquid momentum stocks. You know, the ones that big funds are actually forced to buy. They returned just 8.51%. Think about that for a second. That's not just lower, it's actually worse than just buying a simple Nifty 50 index fund, which clocked in at 10.41%. The entire outperformance, all of the alpha, it's hiding in that illiquid bucket.
So what does this all mean? Well, it pretty much shatters the popular story that momentum is just about investors herding into winning stocks. I mean, think about it. If it was just a behavioral trend, why would the effect completely disappear in the most popular, most traded stocks? It wouldn't. The reality seems to be that the extra return is an illiquidity premium. You're not getting paid for spotting a trend. You're getting paid a reward for taking on the risk of holding stocks that are harder to sell.
And look, this isn't just some dusty academic theory. That number you see, that's over 8,700 crore rupees. That is real money right now sitting in Indian momentum index funds, all invested based on that shiny 14.60% headline number. And what this research is screaming is that there's a huge structural problem for every single one of those funds.
Okay, so here's the trap these big funds are in. They have massive amounts of money to invest, right? But they can't just go and buy those awesome high-performing illiquid stocks, because if they did, their own buying would send the price to the moon. So what are they forced to do? They have to stick to the most liquid, high-turnover stocks. And where is that? As we just saw, it's the exact place where the extra return, the alpha, completely vanishes. They are structurally trapped in the underperforming bucket.
So what can you as an individual investor actually do with this information? Well, you can start asking some really smart, really tough questions. Next time you're talking to your fund manager, don't just ask about returns. Ask them, hey, what's the average scaled turnover of your portfolio? And then follow up. How has that changed as your fund has gotten bigger? And then here's the real kicker. Can you show me a performance split between your liquid and your illiquid holdings? The answers, or maybe the lack of answers, could be very revealing.
And all of this leads to one single powerful takeaway. T. Desai, the researcher behind this study, puts it perfectly. Smaller investors, you guys, actually have a structural advantage here. Your portfolio is nimble enough to get into that sweet spot of low turnover stocks that the giant funds can't even dream of touching. So for once, the edge isn't with the big money, it's with you.
And you know what the best part is? You don't have to take my word for any of this. This isn't some secret sauce they're hiding. The source for this whole explainer, BacktestIndia.com, lets you go on their site and run this exact same analysis yourself, for free. You can go test it and see the data with your own eyes.
Okay, so before we wrap up, it's really important to remember what this is. This whole thing is an explainer of educational research. It is absolutely not investment advice, and as you always hear, past performance is no guarantee of future results. The goal here wasn't to tell you what to do, but to give you a completely new lens to look at momentum through. So the question isn't just, does momentum investing work anymore? The real question is, okay, where does it work, and can my fund even get there?